Let's turn back to the major indexes. Joining me now is Kathryn Rooney Vera, Chief Market Strategist at the financial services company StoneX. Kathryn, thanks for joining me.
Thank you very much, Kristen.
All right, so let's talk about how to make sense of this stock market. The S&P at a 9-month high, volatility below a level of 14. I can't remember the last time that we saw that in the past year or so. What is this? What message is this sending to investors?
Well, I think the message is complacency. I don't think many have anticipated that we are on the cusp of the next phase of the economic cycle. No one knows when that will be, so I'm not here to tell you that recession is next month or next quarter. But I do think that portfolios should be positioning for the next phase of the economic cycle. And that could mean, for example, unwinding positions that have up to this point been overdone, such as the divergence, for example, between energy and NASDAQ, or small caps and NASDAQ. So I think that's one trade to consider. And the other is to build positions in those defensive sectors that historically do well in either stagflation, which is where we are today, or in the next phase of the economic cycle, which is recession.
Okay, so it sounds like, Kathryn, by your measure, I mean, a recession is on the horizon. Typically, I think the stock market drops between 20 and 30% during a recession. That would add a whole lot of volatility to the stock market. Is that potentially on the horizon, even as we've seen momentum building in stocks?
Well, the VIX certainly doesn't see that happening. As you mentioned in your preface, Kristen, the VIX is historically low as an indicative of that level of complacency, which is, I think, more reason to add more defensive positions at this moment in time. The big question we get asked a lot is, what is the Fed going to do? Well, the Fed has to continue to push inflation lower. They're likely to hold at this month's meeting. But my contention, Kristen, is that they're more likely to hike further down the line than cut, which the market has clearly taken out of its forecasts. We know that at the beginning of the year, several cuts were anticipated by the end of 2023. And now, if I'm not mistaken, that has been completely erased.
Mm-hmm. So there is a lot of money on the sidelines. That's kind of the factor that we know, Kathryn. It is hard to fight momentum, right? And trillions of dollars sitting on the sidelines, some in cash, high-yield savings accounts, money market funds, you name it, that are yielding several percentage points right now. Do you think that's one of the reasons we just kind of continue to see this complacent melt up, as you've called it?
Well, at StoneX, for example, we have a lot of different areas of business, and one of them is hedging. And we've seen quite a bit of activity on that front. I think that's judicious for both retail. We have 400,000 retail clients. We have 50,000 commercial and institutional clients. And a lot of those clients are asking about these possibilities, not just securities trading, but hedging their positions, clearing and execution. There's a lot of different areas that you can, as a business or as an individual, high net worth or institutional with a portfolio, preserve that capital and protect it for the long term, because we have to realize that where we live right now with that anchor bias is not permanent. So, economic cycles are cycles. I think it should be realized that recessions are inevitable parts of them. And is it true? Is it real that, the next phase is another bull market, and not just in terms of the S&P, but in terms of economic activity? My strong conviction is that no.
Interesting. So how long is it going to take to work this through the system, Kathryn? Of course, inflation a factor, high rates a factor. The Fed may pause next week, but no indication that it's going to be cutting rates anytime soon.
I think it's such a fascinating topic. All of us economists are talking about immaculate disinflation or immaculate deflation, a soft landing or a no landing. These remind me of a couple years ago when I remember some analysts saying that inflation is a phenomenon that's dead and buried. Well, woe and behold, we have a ton of inflation now. So I think we have to be careful with discarding completely economic principles that have proven to be accurate over the course of centuries. So, for example, unemployment. I think unemployment has to go higher for inflation to come down. It tends to be a controversial position at this point, but I think it's based in, quite frankly, reality. So, we're two-thirds of our economy is based on consumption. If people still have jobs, they're still earning money, not as much as the pace of inflation, but they're earning more money year over year, and they still have a job and they think they can get another one. Those habits of consumption, Kristen, are unlikely to change. So until we see a rollover in the labor market, I don't think recession is around the corner. So that means it could take, to the end of 2024 for this to happen. The Fed doesn't cut before then.
All right. Kathryn Rooney Vera, Chief Market Strategist at StoneX. Kathryn, thank you.